Hey guys, welcome back to another video. Wanted to put up a quick one here today, just detailing out a couple of things that are going on in the housing market right now. I think there's a lot of confusion right now, whether or not we're in a bubble or if the bubble's bursting or if real estate is on fire and everybody's panicking. And I think that where we are right now is probably at the early stages of a cool down or potentially even some crashing. And I found a great article that has 9 charts that details out exactly where we are in the real estate market right now. And so I can help walk you through that and walk you through why we are where we are today and where we might be in 6 months or 12 months. So stick around to the end of the video. Definitely don't want to miss this one. And as always, please do me a huge favor and like the video, comment down below if you have any questions on real estate or any of these charts that I'm walking through. And please don't forget to subscribe to my channel so you don't miss any more great real estate content or content on finance and business. All right, so this article is from businessinsider.com and again has 9 charts that I think really clearly lay out what's happening in the real estate market right now. So let's walk through each of those. So first and foremost, let's lay the ground stage with what's happening with interest rates. So from 2012, you can see the federal funds rate, which was very, very low through until 2016. And this is when the Fed started to increase their federal funds rate to where we got to here in 2020, which of course we know the pandemic hit. And so then they dropped it back down to virtually zero. And since the pandemic, we've been virtually at zero until just recently when the Fed has started to increase rates again. And now this doesn't mean a one-to-one correlation with where interest rates are moving, but it does have a significant impact on them. And so if the federal funds rate is going up from zero, obviously you could expect interest rates on mortgages to increase as well. So this is why we're seeing a massive increase in mortgage rates. And it's not all tied to this. It's also tied to like the risk-free rate or the 10-year treasury yield. So basically, as a lot of experts think we're heading into a recession, that's causing banks to effectively charge more money for the rates, just kind of how it works. It's a little bit complicated, so maybe if you're interested, let me know and I could do a video on that. But what that means is that interest rates have gone from 3% earlier this year to now they're touching 6% and even getting above it. So rates are going up very, very quickly. And because those rates are going up so quickly, purchasing power is going down. So this chart is interesting. So the interest rate is here on the bottom, so 1%, 2%, and then the purchase price of the home. So if we look at where we were, say in 2021 at about 2.5%, for a $2,500 monthly payment at 2.5% interest, you could afford about a $540,000 home. So that's how far a $2,500 payment would get you. Now, if you look at where we're at today, where we're getting close to 6.25, that same $2,500 a month could get you a $390,000 home. So you can see how dramatically these rates impact your purchasing power on a home. So nothing else has changed. It's really just been the interest rate. And that huge difference is just all that extra money that you're paying the bank for interest. So in a general rule of thumb that you may or may not have heard before is that for every percentage point increase in interest rates, it corresponds to a 10% decrease in purchasing power. So of course, because of all this, housing affordability is plummeting. So this is the NAR, or the National Association of Realtors. And this is their affordability index. So through 2021, it was strong in the around in the 150 range. So there's a couple of different metrics that they use to measure home affordability. But then you can see it's dropped off a cliff to where we are now below 110. So a decline of 40 points on their affordability index. This chart here is list prices for homes are finally starting to level off. It's actually a little bit hard to see it in this data because you can only see these last couple of points here. But what this chart was showing is that the list prices for homes, starting from late 2021, just continued to skyrocket until where we got in April. And then when rates started to increase, you could see since then, these new listing prices have largely leveled off. You can see here that there's a lot of seasonality to this. So usually December is the lowest point and then it starts to increase. So again, here you can see December 2019, it starts to increase. Of course, this dip here was the pandemic. December 2020 decrease, and then 2021 increases. Same story here in 2021 of December, decreases. But then we saw a massive increase. And I think a lot of that was the FOMO. As people knew that interest rates were starting to rise, people were starting to jump in. But we are definitely seeing this cool down and start to slow. And I'd say the next interesting chart that really shows how this is being impacted, that the list prices for homes are leveling off. And as a result, we're seeing more homes are being marked down as they're on the market for longer. So this chart here is the national share of active listings with price drops for just single family residential properties. And you can see here in the biggest peak we have is about 21.6% in September of 2019. So 21.6% of all the homes listed on the market had a price drop. And then that dropped. And then of course, 2020 had some interesting data, and you can see a nice little, bell curve here in the summer. This is probably, 2019 and 2021 are probably the only somewhat normal years on here. So you can see usually there's an increase toward the end of the year, toward the late summer, as people are really trying to sell off their homes before we get into winter months. And the same thing is exactly what we're seeing here in 2021. So this chart really directly follows the one previously, as we're seeing the slowdown in price appreciation. And just to orient you guys to this chart, so this is the percentage of the total homes listed on the market that have a markdown or a price reduction from whatever the list price was when they listed the home. So you can see here the peak on this chart was September of 2019, where 21.6% of all the homes listed had a price drop. And this declined significantly to where it was in the 6% range in January through May of 2021. Also saw a similar decline here, where we got down to 6% in February. But this is starting to spike, and I think most importantly, it's starting to spike a lot earlier than normal. So of course, real estate is extremely seasonal, with more listings and more homes coming on the market usually in May, June, July timeframe. And peak selling is in the summer to early fall. And then as we saw here in 2019, as we get to late summer and into early fall, people are really trying to sell their homes if they're trying to move. People with families have kids in school, and so they're trying to move by August or September so they can be in place for the next school year. So that's why you see a lot of seasonality in the housing market. So it's pretty normal to see spikes there toward the end of the summer. And we saw that a little bit here in 2021, but you can see it didn't really start to spike. Just the last year we have from February, March, April, May, it's largely flat, anywhere between 6 and 7%. So we didn't see a jump up and increase. But the difference with 2022 is you can see February came, and then March and April, and I fully expect May and June to be similar trajectories, heading up in this direction, is that these markdowns are happening much, much earlier in the year because of interest rates. Now, one of the biggest issues for the real estate market recently has just been how quickly homes are being sold. I'm sure everybody knows a couple of stories of people who list a great home for a reasonable price and literally has 20, 30 offers within 2 or 3 days, and the home is sold within a week or two. So this has been super normal. And so this chart really shows exactly what's happening here. So real estate sales are taking slightly longer, emphasis on slightly. And this chart shows the national share of homes off market within 2 weeks. So in 2019, it was a very small amount, anywhere from 30 to 40, and similarly in 2021. And then it spiked in 2020, and then spiked in 2021 to be over 60% of homes, so almost 2/3 of all homes sold were off the market within 2 weeks. And we saw a similar spike here by February, which again, you wouldn't expect this spike to happen until a little bit later in peak real estate season, so until June or July. So again, this is starting to slow down, but we're still, at similar areas to where we were in March of April from last year. But I still fully expect really great homes that are well priced to be sold quickly. But it's all those other homes that you heard stories of, homes that were less than desirable, weren't that fantastic, were frankly beat up a little bit, and people were just throwing out offers left and right because they just couldn't get anything. So I think those are the homes we're going to start to see staying on the market a lot longer. And we'll see this chart start to trend downwards where a smaller share of homes is going to be sold within a week or two. Now, this next chart is the months of supply of homes for sale is ticking up, but still quite unbalanced. And this is the national supply of single family residential properties. So how to read this chart is here in February of 2012, we had 6.8 months of inventory, which meant if no further homes were listed on the market, it would take 6.8 months to sell through the entire inventory here. And this has really been trending downwards for a number of years, but sort of stabilized in late 2017 through 2018, 2019, and obviously 2020. But man, you can really just see this dramatic decline here that is different from any of the trends that we saw before, to where months of supply drop down to about a month. If we stop listing new homes, every single home that is for sale today would be gone within 1.2 months. So pretty crazy. So we really haven't seen this start to tick up yet. But again, this is a lagging indicator. So I wouldn't expect this to be something that we see real good data on until maybe July or August. We start to see the trends a little bit clearer. And of course, naturally following onto that is the number of active listings. It's still pretty low here. Normal trend here was anywhere from $1.5 to $2 million from trough to peak. And again, you can see this is a really good chart to show the seasonality here of real estate. So November, December, January typically has fewer listings because people just aren't listing homes. And as a result, people aren't buying homes as quickly. And then people start to list and sell and buy new homes in the summer months. So that's why you see all these peaks and troughs. But inventory nationally is just so low right now. So even though we're heading into the higher sales summer months, we still haven't seen inventory numbers climb and return to where they should be. So, a really important thing about real estate that we have to remember is that it's all based on supply and demand. And it's pretty clear that demand is softening as people just can't afford homes anymore and interest rates have skyrocketed. But it just takes a little while for the supply to catch up. So it's not an immediate thing. There's no single event. Like in 2008, what happened was there was a massive forbearance crisis and people just couldn't afford their homes, and so they got foreclosed on. And so that meant there was a massive just dump of homes onto the market that was outside of the normal. So that increased supply so quickly. At the same time, demand decreased because of the recession. And so the combination of those two led to a housing market crash. So I don't think that's going to happen this time because there's just not going to be an event that we're going to see a massive dump of inventory onto the market to increase supply. But I think we will see a steady return of supply to where we were, here in 2013 through 2016, these normal levels. And because of that, we'll definitely see prices come down. And this chart just shows new home construction is behind. You may or may not have heard this before, but basically the prevailing thought is that there is a glut of inventory because builders built a ton of inventory here up until 2006, but then the housing market crash and the recession in 2008 brought this down, this industry really down to its knees. And it's slowly recovered. But I think the numbers going around is that there's an estimate of anywhere from 4 to 5 million homes that we're short in the US right now. So, and of course, new home inventory is not building at a quick enough pace to complete that. All right, and that's really it. So again, I think it all comes down to the supply and demand factors in the market. It's clear that we're seeing some really hits to demand right now, and people are just not able to afford the homes with prices and rates so high. And if we start to head into an actual recession and people start losing their jobs, it's going to continue to soften demand. But what we're waiting on is that rebound in supply. We're still only at 1.2 months of inventory right now, and we need to get back up to 6, 7, 8, or 9 months of inventory to be at just normal levels. And then at that point, I think that's when we're really going to start to see prices come back down to earth. All right, guys, I really hope you enjoyed the video. I hope it was helpful for you to understand holistically what's happening in the housing market. So do me a huge favor and like the video and subscribe to my channel if you'd like to see more content similar to this. I also put out content on finance and business. All right, thank you again, and I will catch you guys in the next one.